Imagine for a second that you walk into your boss's office, or maybe you're the CEO walking into a board meeting.
Right.
You take your seat, you look your stakeholders dead in the eye, and you deliver what should, theoretically at least, be the greatest financial news in the history of corporate capitalism.
Yeah, the absolute peak.
Right. You tell them that in the last 3 months alone, I mean, just a single 90-day window, you have generated a profit of $112 billion.
Which is, it's just a figure so staggeringly large that the human brain actually struggles to contextualize it.
It really does.
I mean, we were talking about GDP-level wealth generated in a single fiscal quarter.
Yeah, I actually looked it up before we started recording, and that quarterly profit is roughly equivalent to the entire annual economic output of like a medium-sized country.
Wow. Yeah, that makes sense.
It is literally the largest quarterly profit any publicly traded company has ever booked anywhere in the history of modern markets. And so, how does the market react to this historic, record-shattering windfall? Within 24 hours, the market essentially penalizes them. The stock absolutely craters, plummeting 7% in a single trading session.
Which, at this specific company's market capitalization represents tens of billions of dollars in shareholder value, just instantly wiped off the map.
Erased.
Yeah, erased into the ether, despite a record-breaking profit.
It's wild. So welcome to Behind the Moat. Today, we are taking a little detour from our usual company brief format. We are dedicating this 13th deep dive. This is episode 13 of Behind the Moat, a standalone essay episode.
Exactly.
And we're dedicating it to unpacking one highly specific, incredibly detailed, and honestly deeply controversial piece of research about Alphabet's massive capital expenditure strategy.
It's quite the read.
It really is. But wait, before we get into the paradox of that $112 billion profit, I need to state the ground rules for today's discussion right up front very clearly for everyone listening.
Yeah, this is non-negotiable for the kind of granular financial analysis we're about to do.
Absolutely. So plain and simple, this deep dive is strictly for educational and informational purposes only. I want to be super clear. It is not investment advice.
Right. Not at all.
We are not providing you with price targets. There are no buy or sell recommendations being made here, and you will not hear a single forward-looking estimate from us about what Alphabet stock or, any other stock is going to do tomorrow or next year.
Yeah, I want to reinforce that so there is zero ambiguity for you guys. What we are doing today is unpacking the mechanics of a highly complex accounting argument, and it's based entirely on public SEC filings, audited historical data, and corporate track records. And we're basically looking at how a business measures its spending, how the physical reality of infrastructure translates to a balance sheet, and what the financial plumbing of the AI revolution actually looks like. We are entirely agnostic on the stock's future trajectory.
Exactly. Okay, so with the guardrails firmly in place, let's unpack this opening paradox. Because on July 22nd, 2026, Alphabet reported that $112 billion profit.
Right.
Now, the essay we are exploring today immediately demands that we apply some vital context to that number. Because if you just read the headline, you might assume they pulled in $112 billion in cold, hard cash from, selling search ads and cloud software.
Yeah, and the composition of that profit is the first major plot twist here. Roughly $77 billion of that total figure actually came from after-tax gains on stakes that Alphabet holds in other companies.
So wait, we were talking about paper marks?
Yes.
This isn't a mountain of cash just sitting in a vault in Mountain View. It means the value of the startups and external ventures they invest in went up in value on paper, and accounting rules dictate that they recognize that gain.
Precisely. It is an accounting gain, an unrealized valuation bump. But, and this is a massive but that the market seemed to completely ignore, even if you strip all those paper gains away, right? If you isolate just the core operational engine of the business, you are still left with an operating profit for the quarter of $35 billion.
Okay, I want to isolate that specific variable for a second. $35 billion in core operating profit. I mean, by any normal historical metric of corporate performance, a $35 billion quarterly profit is not just superb, it is a mammoth industry-defining quarter.
Oh, absolutely. It demonstrates that the underlying cash generation machine is just functioning flawlessly.
And yet, as we established, the stock dropped 7%. Wall Street looked at a $35 billion core operating profit and literally hit the sell button.
Yeah.
So, what was the culprit? What specific piece of data spooked the market so violently? It all comes down to one single line item. Alongside that earnings report, Alphabet raised its 2026 capital expenditure plan, what we in the finance world call CapEx, to a newly revised maximum of $205 billion.
And to truly grasp why the market panicked, you really have to contextualize the sheer velocity of that spending increase. That $205 billion projection is more than double the $91 billion they spent just last year. And if you go back slightly further, it is over 6 times what they spent just 3 years ago in 2023.
Wait, 6 times the infrastructure spending in a 36-month window?
Yes.
So if I'm an institutional investor reading this tape, I see a runaway train. I see a speculative, reckless, honestly out-of-control bet on artificial intelligence infrastructure that has no guaranteed payoff.
Right, that's the natural instinct.
But the author of our source essay looks at that exact same $205 billion figure and draws the complete opposite conclusion. They argue that this massive CapEx number is currently the single most misunderstood line item in the entire global technology sector.
And that tension is really the core of our exploration today. We are going to decode the critical mechanical difference between operating expenses and capital expenses, which is the foundational key to unlocking this whole mystery. We'll examine the bull case, which relies on a staggering explosion in contracted cloud revenues, but we're also going to give equal weight to the very serious bear case, specifically digging into Michael Burry's famous objections about how depreciation schedules might be artificially inflating tech profits.
Oh, yeah. That part is fascinating.
It is. And we'll look at that alongside a truly historic negative cash flow metric that just hit Alphabet's books for the first time in 2 decades. And finally, we'll look at Google's own history to see how this exact cycle of extreme spending and market panic has actually played out before.
It is a massive intellectual puzzle. But to understand a $200 billion spending plan without getting lost in the weeds, we have to start at the absolute foundation. I want to explicitly slow the conversation down right here.
Good idea.
Because if you as a listener don't grasp this next mechanical accounting distinction, honestly, nothing else about this $200 billion number or the AI boom in general will make any sense.
Yeah, it is the bedrock of corporate finance. We have to dispel this illusion that corporate spending is just, one big bucket of money leaving the building.
Right.
It is strictly divided into 2 very different categories, and the accounting rules treat them in vastly different ways on the balance sheet.
Okay, let's unpack this. Let's use the analogy straight from the essay because it perfectly crystallizes the mechanics. Imagine you own a neighborhood bakery. You have a staff of bakers that you pay every Friday to knead the dough. You have cashiers working the register, and you have a monthly electricity bill to keep the lights on and the mixers running, paying your staff their wages and paying that utility bill that falls under operating expense, or OPEX.
And the defining characteristic of an operating expense is immediate consumption.
Okay.
The economic value of that money is consumed instantly. It goes out the door to keep the business alive today, and it never returns in the form of a tangible long-term asset.
So it's gone.
Exactly. When you pay your cashier their weekly wage, that exact dollar amount is immediately subtracted from that week's profits. It is a sunk cost of doing business in the present tense.
Right. So OPEX is basically the calories the business burns just to survive the day. But what happens when your bakery becomes wildly popular? Like there's a line around the block and you need to expand your capacity.
You need more ovens.
Exactly. You decide to go out and buy a massive industrial-grade, top-of-the-line new oven for, say, $100,000. That oven is going to bake bread for you every single day for the next 10 years.
Right.
Buying that oven is not an operating expense. That is a capital expenditure, or CapEx.
And this is where accounting mechanics step in to ensure the balance sheet reflects economic reality, rather than just raw cash movement. You do not subtract the entire $100,000 cost of that massive industrial oven from the bakery's profit this year.
Even though you spent the cash.
Even though the cash left the bank account. If the accounting rules force you to do that, your highly successful expanding bakery would suddenly look on paper like it was losing massive amounts of money simply because you invested in your own future capacity.
Because the oven has what accountants call a useful life. Like, it is going to generate revenue and value for a decade, not just for the Tuesday you bought it.
Exactly. So generally accepted accounting principles, or JAP, require you to spread the cost of that oven over its useful life. You take one slice of the oven's $100,000 cost, say $10,000, and you apply it as an expense to each year it operates.
Gotcha.
That annual slice, that deliberate spreading out of the costs over time, is called depreciation. Depreciation is simply the mechanical way accounting matches the upfront cost of a long-lived physical asset to the actual years it earns its keep.
Okay, let me make sure I'm fully mapping this bakery analogy onto a trillion-dollar tech giant, just to ensure the underlying mechanism is crystal clear for you guys listening. When Alphabet announces they are raising their CapEx plan to roughly $205 billion, the market is hitting the panic button. But mechanically speaking, on the income statement, Alphabet is not actually deducting $205 billion from their 2026 profits, are they?
No, and that is the crucial misunderstanding driving a lot of the retail panic.
Right.
Alphabet is not setting $205 billion on fire in a single calendar year. They are acting exactly like the bakery buying the industrial oven. They are trading cash for long-lived physical assets.
And their ovens are huge.
Exactly. In their case, they're buying thousands of acres of land, constructing massive concrete data centers, installing industrial liquid cooling systems, and racking up millions of physical AI servers.
Oh, wow.
The actual cost of those physical assets will hit their profit statement very slowly, sliced up over many years through that exact mechanism of depreciation.
So, the market sees a $200 billion cash outflow and instinctively treats it like an immediate, terrifying hit to the company's profitability. But fundamentally, they are conflating cash flow with the income statement.
Yes.
The money is leaving the building, but it's being traded for hard, tangible infrastructure that holds long-term economic value.
Precisely. The cash absolutely leaves the Treasury, and we're definitely going to explore the severe consequences of that cash drain later in the deep dive. But the profitability metrics of the company are protected in the short term because the expense is amortized.
Makes sense.
Therefore, the most vital question isn't how the money is being accounted for, but why it is being spent in the first place, and whether the demand justifies the scale of the ovens they are buying.
Which bridges us perfectly to the core of the bull case. Now that we understand how the money is moving through the accounting plumbing, we need to ask why Alphabet feels compelled to buy so many digital ovens right now. The dominant narrative out there, the one you read in the financial press every day, is that artificial intelligence is a massive speculative bubble.
Right, the AI hype cycle.
Exactly. The critique is that these hyperscalers are building these colossal data centers on pure faith, hoping that someone, someday, will invent an application that requires all that computing power. It's the classic build it and they will come field of dreams mentality.
And the author of our source essay violently disagrees with that narrative,
Yeah.
specifically when applied to Google Cloud. Their thesis is that Alphabet is not building for a speculative, distant, imaginary future. They are building massive infrastructure today to fulfill literal orders that are already sitting on their books.
And this is where the sheer scale of the numbers gets truly staggering. Let's talk about the backlog. The essay highlights this as the single most important metric that mainstream commentary completely glosses over. As of the end of the quarter, Google Cloud's official revenue backlog stands at an astonishing $514 billion.
We need to pause and define that term very carefully because outside of enterprise sales, backlog sounds like a negative thing.
Yeah, it sounds like chores.
Right. It sounds like a pile of unread emails or work you are too far behind to finish. But in JAP accounting, a revenue backlog is not a hope. It is not a sales team's pipeline of potential leads. It is not a forward-looking forecast, and it is absolutely not a projection of future market share.
I need to push back on that, or at least clarify it, because $500 billion is a dizzying number. If it isn't a projection, what exactly constitutes that $514 billion bucket? Like, how ironclad is it?
It is signed, contracted, legally binding business.
Wow.
When a massive global enterprise, say a multinational bank, a major healthcare provider, or a global retailer commits to shifting their operations to Google Cloud, they sign a multi-year contract, usually spanning 3 to 5 years.
Okay.
That contract includes minimum spend commitments. It becomes a legal obligation for that enterprise to pay Google. That contract sits on Google's balance sheet as a backlog, essentially waiting in a holding pattern, and it only converts into recognized revenue the moment Google actually delivers the computing capacity to the client.
So This is $500 billion in signed legal obligations. If a Fortune 500 company signs $1 billion cloud deal, they are legally on the hook for that spend, and that sits in the $514 billion bucket.
Exactly.
That changes the entire complexion of the CapEx spend. And it's not a static historical number either. The velocity of how fast this backlog is growing is what truly broke my brain when reading this.
It's wild.
In the June 2026 quarter alone, just a single 90-day period, that backlog grew by $52 billion.
Which tells you something profound about the physical constraints of their business. They are signing new enterprise contracts faster than they can physically pour the concrete and rack the servers to fulfill them.
Yeah.
And Alphabet's management has stated publicly on their earnings calls that they expect over half of this $500 billion sum to convert into actual recognized revenue within the next 24 months.
Let's do the math on that. Within 2 years, over $250 billion of that contracted backlog is going to wash right through the income statement as top-line revenue.
Yeah, and if we connect this to the bigger picture, when you view the $205 billion CapEx plan through the lens of that backlog, the speculative bubble narrative completely disintegrates for the author.
It's not a field of dreams at all.
Not at all. Alphabet isn't laying railroad tracks out into an empty, uncharted desert, hoping a train eventually comes along to use them. They are frantically laying tracks right in front of a heavily loaded freight train that is already speeding forward. A train that has already sold all of its tickets and is demanding a place to go.
And the current present-day profit reality proves it. We are just talking about abstract future revenue converting from a backlog someday. The money is landing right now, this quarter. Let's look at the metrics for the Google Cloud segment specifically. Last quarter, cloud revenue grew 82% year over year to $24.8 billion.
Growth is certainly impressive, but in the infrastructure business, profit is the only metric that ultimately matters. Top-line revenue is vanity. Bottom-line profit is sanity. Operating profit for the cloud segment didn't just grow. It structurally transformed. It tripled.
Tripled.
Yeah. It went from $2.8 billion a year earlier to $8.8 billion this past quarter alone.
But the metric that really demands our attention is the margins. Operating margins in the cloud segment expanded massively, leaping from 20.7% to 35.6%.
That's the real story.
We have to pause and really chew on that number. They are pouring hundreds of billions of dollars into new infrastructure, yet their profit margin on the services they are actively selling jumped by nearly 15 percentage points.
It is the rarest and most highly prized pattern in all of business strategy. Revenue growth and profitability rising simultaneously at scale.
Because usually you have to pick one, right?
Usually the laws of economic gravity dictate a trade-off. When a company wants to grow 80% year over year, it has to aggressively cut prices or spend heavily on marketing to capture market share, which sacrifices margin. Conversely, if a company wants to protect high margins, it usually has to sacrifice hypergrowth and focus on a premium niche. Alphabet's cloud division is currently defying that gravity. They're accelerating growth while drastically widening their profit margins.
And we shouldn't pretend this is purely driven by boring back-end enterprise contracts. The consumer demand is pulling incredible weight on the infrastructure, too. Look at Gemini, their flagship AI assistant. The essay notes it now has 950 million monthly active users. That is up from 750 million just 2 quarters prior.
And adding 200 million active users in 6 months to a single compute-intensive product line requires an absolutely immense amount of underlying physical hardware.
I can't even imagine.
Every time one of those 950 million users asks Gemini to draft an email, analyze a spreadsheet, or generate an image, a physical server in a data center somewhere has to execute that math in milliseconds.
Not to mention the 350 million paid subscriptions across Google's consumer services ecosystem. People are actively swiping their personal credit cards for this capability. So if we summarize the bull case, it presents a very clear logical argument. The $200 billion CapEx plan isn't a gamble.
No.
It is the mandatory, unavoidable cost of fulfilling a mountain of demand that is already here, already contracted, already paying, and already generating massive expanding profits.
It is a compelling thesis, but this naturally leads us to a glaring contradiction in the math, doesn't it?
Right. And here's where we get to what I call the margin mystery. I want to put myself in the shoes of the skeptical listener again. I'm looking at my own household budget, or like a small business budget. If a company literally doubles its capital spending in a single year, moving up toward $205 billion, surely the overall profit margins of the entire corporation must be getting crushed under the weight of that spending, right?
That's the logical assumption.
Even with depreciation spreading the cost out over multiple years, the sheer volume of new ovens being added to the books must be creating a massive new drag on the bottom line.
That is the entirely logical assumption to make.
Yeah.
It is exactly the assumption the broader market made when they panicked and sold the stock down 7%. They assumed the infrastructure costs would cannibalize the core business profits. But the surprising reality, and the essay hammers this point home relentlessly, is that the exact opposite is occurring.
Yeah.
Alphabet's total corporate operating margin actually expanded last quarter.
It went from 32% up to 34% overall, a 200 basis point expansion while doubling CapEx. How is that physically possible?
Let's break down where that expansion is originating, because it reveals the strength of the underlying unit economics.
Yeah.
First, you have the core advertising business, what they categorize as Google services, which encompasses traditional search and YouTube. That segment is still generating a massive 42% operating margin. And search revenue itself, which many predicted would be killed by AI chatbots, was actually up 17%. The core engine is still printing money at near monopoly margins.
But the most shocking part of the margin story isn't search, it's the cloud segment. Cloud is the specific division that is absorbing the vast majority of this massive infrastructure spending. They are the ones buying all the real estate, pouring the concrete, securing the power agreements, and installing millions of bleeding-edge AI servers.
Exactly.
By all logic, their margins should be the ones contracting. Yet cloud is the segment seeing its margins climb the fastest, hitting that 35.6% we just highlighted.
To understand why, you have to understand the unit economics of a data center. A data center is largely a fixed cost asset. Whether a server is running at 10% utilization or 90% utilization, the cost to build the building, secure the land, and even power the baseline infrastructure remains relatively static.
Okay, that makes sense.
When you have a massive influx of demand, like that $514 billion backlog coming online, your utilization rates skyrocket. Every incremental dollar of revenue generated on a fully utilized server drops almost entirely to the bottom line. The revenue scales exponentially, while the amortized cost of the hardware scales linearly.
So it's like a commercial airline. The cost to fly a 747 from New York to London is basically fixed whether there are 50 people on board or 300 people on board.
Yes, exactly.
If the plane is half empty, your margins are terrible. But once you cover your fixed costs, every single additional ticket you sell is almost pure profit. Alphabet is filling every single seat on their AI planes, which is why the margins are expanding despite buying more planes.
That is a perfect analogy.
Yeah.
And it brings us to the ultimate takeaway for this portion of the analysis. If this massive capital expenditure was truly destroying value, if it was reckless waste building empty capacity, the margins would inevitably be sliding as the spending ramped up.
Right, because of all the new ovens.
Right. The depreciation expense of all those new servers, even spread out, would be overwhelming the new revenue because the servers would just be sitting idle.
But because the margins are aggressively widening while the spending is doubling, it empirically proves the investments are yielding immediate, highly profitable returns. The author states that this single, audited, fact-widening margins alongside doubling CapEx should give any rational bear a serious pause.
It forces you to question the initial market panic, for sure. However, it would be intellectually dishonest of us to stop the analysis here and crown the bull case the winner, because the bears do have a counter-argument, and it is an incredibly sophisticated, structurally terrifying one.
I have been waiting for this. Here's where it gets really interesting, because I want to introduce the strongest intellectual pushback against this entire bull thesis. And as mandated by the instructions for today's deep dive, we have to present this fairly objectively and give it its full, unvarnished weight. We are talking about the famous depreciation objection raised by Michael Burry.
Michael Burry, for those who might not recognize the name, is the legendary investor, most famous, for successfully predicting the 2008 housing crash and massively shorting the subprime mortgage market.
The Big Short guy.
Exactly, famously chronicled in the book and film The Big Short. He is a physician-turned-hedge fund manager, and his defining characteristic as an investor is his willingness to dig deep into the arcane, highly technical accounting plumbing, where most analysts simply don't bother to look.
Right. He doesn't just read the top-line revenue, he reads the footnotes on page 184 of the annual report. And in November 2025, Burry started making a public argument against the major hyperscalers, the massive cloud providers like Amazon, Microsoft, and Google.
Hmm.
Then, in February 2026, he escalated the critique and named Alphabet explicitly. Burry essentially accused them of artificially inflating their incredible profits by quietly and systematically understating their depreciation expenses.
Let's calmly break down the mechanics of his accusation, because it goes right back to our bakery analogy, and it is brilliant in its simplicity. Remember, depreciation is how you spread the upfront cost of a physical asset over its assumed useful life.
The slices of the oven.
Exactly. Now imagine you buy a high-end AI server for your data center for $30,000.
Hmm.
You tell your accountants and your auditors, based on our engineering models, this server will remain useful and competitive for exactly 3 years.
Okay.
You divide the $30,000 cost by 3, which gives you an annual depreciation expense of $10,000. That $10,000 lowers your reported profit by that exact amount every year for 3 years.
That makes perfect logical sense.
But what if, a year later, management decides to simply change their internal assumption? What if they release a memo saying, actually, upon further review, we think this server will remain useful for 6 years instead of 3?
Uh-oh.
Suddenly you are dividing the remaining cost by 6 instead of 3. The annual depreciation expense is instantly mechanically halved.
Let me make sure I am fully grasping the implication here. Your expenses for this current year just dropped dramatically, not because you became more efficient, not because you found a cheaper supplier, but purely because an executive changed an assumption on an Excel spreadsheet.
And because your reported expenses artificially dropped, your reported profit for today instantly spikes. Burry's argument is that by systematically extending the assumed useful life of AI hardware, these tech behemoths are artificially pushing their true expenses into the distant future.
Wow.
They are making today's profit margins look incredible, but they are hiding the true, punishing cost of running an AI infrastructure business.
And here is the absolute kicker. Alphabet actually did this. This isn't just a hypothetical theory Burry invented out of thin air. The essay explicitly points out the documentary evidence. In 2021, Google officially changed the assumed lifespan of its servers from 3 years to 4 years. Then, just 2 years later in 2023, they extended it again from 4 years to 6 years. And they were by no means alone in this practice. Meta and Microsoft executed the exact same accounting maneuvers around the same time. So Burry looks at these incredibly high margins we were just celebrating, that 35.6% operating margin in the cloud segment, and he argues that they are fundamentally untrustworthy.
Right.
He claims those margins are a financial mirage created by aggressive accounting assumptions, not a reflection of genuine sustainable economic strength.
I have to say, it is a devastating critique if it's true. Because if the hardware actually becomes obsolete in 4 years, but they are accounting for it over 6 years, they are essentially borrowing profits from the future to make today look good. It's a ticking time bomb on the balance sheet. So I have to challenge the premise here. How can we possibly know if Google is faking it? How do we, as outside observers, know if a bleeding-edge AI server really lasts 6 years? Or if the sheer heat and technological advancement are going to render it obsolete in 4, leaving them holding the bag? It is the most critical question you can ask, and the essay's author, who explicitly notes they are currently finishing a degree in advanced accounting, brings in a very specific, historically grounded rebuttal. It relies on 2 verifiable factors: a decade of real-world operational history and the strict, legally binding obligations of corporate auditors.
Let's start with the history, because this, frankly, blew my mind when I read the source material. We all culturally think of this AI boom as something that started roughly 2 years ago with the launch of ChatGPT. We assume Google has only been buying this specific type of hardware for 3 years max.
That is a massive misconception. Google hasn't just been buying off-the-shelf hardware for 3 years. Google has been designing its own custom, highly specialized AI chips called Tensor Processing Units, or TPUs, since 2013.
Wait, 2013?
Yeah, and they have had them actively installed and running high-intensity workloads inside their global data centers since 2015.
Wow, 2015. So they have over a decade of real-world hardware telemetry.
Exactly. That is over 10 years of empirical data on thermal degradation, component failure rates, and architectural longevity spanning multiple generations of custom silicon.
Oh, I see.
When Google goes to their auditors and says, our data indicates these servers will last 6 years, they aren't guessing based on a manufacturer's spec sheet. They are providing empirical, historical proof spanning a decade of continuous operation.
But, I'm going to play devil's advocate again. Even if they have history, what if they are just stretching the truth now because the spending has gotten so extreme? What is the auditor mechanism you mentioned? What actually stops them from just lying?
This is the ultimate failsafe against Burry's theory running indefinitely. Depreciation isn't a fictional number that management can simply invent and force a major accounting firm to blindly accept.
Okay.
Let's run a hypothetical scenario. Let's say a company books a fleet of servers to last for 6 years entirely to make their current profits look spectacular. But in harsh reality, the hardware is technologically obsolete or literally burns out after just 4 years.
What happens then? The company can't just pretend the dead server is still processing data.
Precisely. They have to physically decommission and retire the asset from the data center.
Yeah.
And when they remove an asset from service before it is fully depreciated on the books, the external auditors are legally obligated to force an immediate correction.
Ah.
That gap between the fictional 6-year assumption
Yeah.
and the harsh 4-year reality surfaces violently on the income statement as a specific accounting charge called an impairment.
An impairment. I need a non-tech analogy for this to really cement it in my mind.
Think about a delivery company buying a fleet of brand new electric vans. They assume the vans will last 10 years, so they depreciate them slowly. But in year 3, a massive flood destroys the entire fleet. The vans are useless.
Oh, wow.
The company can't keep depreciating them for another 7 years. The auditors force them to take the entire remaining value of those destroyed vans and write it off as a massive loss on that specific quarter's earnings. That is an impairment. It is a sudden, massive, undeniable write-off. The truth always, inevitably, catches up on the balance sheet.
Okay, that makes perfect sense. So the essay provides a real-world tech example of this, right?
Yes, the author gives a perfect recent example involving a competitor. In 2022, Meta was in the process of building massive data centers, but halfway through they realized their architectural design was already obsolete for the newer AI workloads they needed to run.
Right.
They had to abandon the partially built centers. Because those physical assets were no longer useful to the business, the auditor stepped in, and Meta was forced to take a massive $1.3 billion impairment charge against their earnings in a single quarter.
So the mechanism works. If a company is faking the useful life of an asset, the impairment charge eventually exposes them. Which brings us back to Alphabet. If Alphabet has been stretching these depreciation assumptions too far to hide the cost of their CapEx, if they are stretching a 4-year server into a fictional 6-year lifespan, we should absolutely see these impairment charges popping up all over their earnings reports, right? As the old, overworked servers die early, there should be sudden, multi-billion-dollar write-downs.
That is the ultimate reality check. The author urges us to ignore the theories and look at the actual legally mandated audit trail. If you search through every single 10K annual report and 10Q quarterly report followed by Alphabet from 2018 all the way up to today, you will find something truly remarkable.
What does the audit trail actually say?
Over that entire 8-year span, encompassing the transition to multiple generations of AI hardware, there is not a single material impairment, abandonment, or accelerated depreciation charge related to servers, network equipment, or data center infrastructure.
0. Over an 8-year period of explosive technological change, they haven't had to write off a single massive batch of obsolete servers.
None that reached the threshold of materiality required for disclosure. The physical asset register and the retirement records, which are audited by independent accounting firms every single year, do not lie.
Wow.
If the hardware was becoming worthless or obsolete faster than management claimed, the write-offs would have been unavoidable. Billions in sudden, embarrassing charges would have hit the books, just like they did for Meta.
The essay hilariously notes that the only material impairment charges Alphabet has been forced to take recently were on corporate office space. They misjudged the post-pandemic real estate market, but their server math is flawless.
So while Michael Burry's mechanism is theoretically valid in the abstract, and it is absolutely a dynamic that investors should monitor across the broader tech industry, when you apply it to Google's specific, documented 10-year track record of custom silicon design, the author argues there is simply much less room to hide than the bare thesis requires. The hardware, quite simply, actually is lasting as long as they claim it is.
Okay, so the depreciation argument is thoroughly mitigated by their long history of building chips and the pristine audit trail. But we cannot dismiss the bear case entirely, because right after debunking the accounting trickery, the essay introduces what it dramatically calls the scariest number.
And this is not a theoretical argument about useful lifespans. This is a hard, undeniable mathematical fact that arrived this exact quarter. It is not an analyst's opinion, and it cannot be massaged by depreciation schedules.
Right.
It is, without question, the strongest piece of evidence justifying the market's severe panic.
For the first time since going public in 2004, a streak spanning over 20 uninterrupted years, Alphabet's free cash flow went negative.
We need to explain exactly what free cash flow measures. Because in the hierarchy of financial metrics, free cash flow is often considered the purest, most unmanipulable measure of a corporate entity's health.
Please do, because when I saw that metric in the text, I genuinely had to stop reading and look at it twice to make sure it wasn't a typo.
To calculate free cash flow, you start with the actual physical cash the business generates from its day-to-day operations, the literal cash they collect from selling search ads, YouTube subscriptions, and renting cloud space.
Okay, money in.
Then you subtract the actual cash they spent that quarter on capital expenditures, the physical cash wired to construction companies and hardware suppliers to build those data centers. Whatever physical cash is left over after that subtraction is considered free.
Right.
It is the discretionary cash they can use to pay dividends to shareholders, execute stock buybacks, acquire other companies, or simply stockpile on the balance sheet for a rainy day.
And for 2 decades, Alphabet has been the undisputed king of free cash flow. They have been an absolute cash geyser, printing money so fast that they literally couldn't find enough things to spend it on. But this past quarter, under the crushing weight of the $205 billion CapEx plan, the math fundamentally inverted.
Let's look at the exact figures. The cash generated from operations was incredibly strong. $39.1 billion in a single quarter.
A phenomenal number, a fundamentally healthy business.
But the cash required for capital spending was $44.9 billion.
Which leaves a gap, a very terrifying negative gap of $5.9 billion.
Minus $5.9 billion. Alphabet spent nearly $6 billion more in physical cash than it generated in a 3-month period.
I want to make sure the gravity of this translates to you listening. A company defined by its infinite, almost magical cash generation is now, for at least 1 quarter, actively burning cash. It is spending more than it makes. When the CFO was forced to admit this negative print on the earnings call, you can imagine the collective gasp across Wall Street. It breaks the fundamental mental model investors have of what Alphabet is.
Now, to properly contextualize the fear, we must zoom out and look at the slightly broader picture. If you look at the trailing 12 months, the last full year of operation, their cumulative free cash flow is still comfortably positive at roughly $53 billion. They're not in any danger of running out of money.
Right, they have a massive war chest of cash sitting on the balance sheet anyway. This isn't a startup about to miss payroll.
Exactly. But in financial markets, the direction of travel is often more important than the absolute number. The trajectory line on the cash flow chart is pointing steeply, violently downward. The massive, unprecedented capital requirements of building the AI future are dragging what was arguably the most profitable business model in human history into negative cash flow territory. This is fundamentally why the market panicked and wiped 7% off the valuation. It represents a structural shift in the financial gravity of the company.
So we find ourselves at an incredible analytical crossroads. How on earth do we reconcile these two realities? On one hand, we have exploding, highly profitable, contracted demand in the cloud segment with expanding margins. But on the exact same balance sheet, we have terrifying negative free cash flow and a capital spending plan that requires over $200 billion.
It's a kaplash.
Which side of the scale ultimately wins? The essay argues that the answer doesn't require us to guess the future. The answer lies explicitly in Google's own past.
If we want to know how this specific scenario plays out, we don't need predictive models. We just need to rewind the clock to the year 2018, because Google has run this exact playbook, faced this exact market panic, and endured this exact financial strain before.
Okay, set the historical scene for us. What was happening in 2018?
In 2018, the narrative around cloud computing was very different. Amazon's AWS was the undisputed king, Microsoft Azure was a very strong second, and Google Cloud was viewed as a distant, confused, and struggling third-place player. And in 2018, Alphabet did something they had never done before. They finally disclosed the specific earnings and losses for Google Cloud as an independent operating segment. Prior to that, the numbers were hidden within the broader corporate financials, and when they finally opened the books and showed the world the unit economics of Google Cloud, it was an absolute bloodbath.
Define bloodbath. How bad were the numbers?
Google Cloud lost $4.3 billion in operating profit in 2018 alone.
A $4 billion hole in 1 year.
And it did not get better quickly. Building global cloud infrastructure takes time. Cloud lost money again in 2019. It lost money in 2020. It lost money in 2021. And it lost money in 2022. That is 5 consecutive years of massive red ink. The cumulative total losses for that 5-year period were $18.8 billion.
And while they were incinerating nearly $20 billion over 5 years, what was their strategy regarding capital spending? Did they pull back to protect profits?
They did the exact opposite. They rammed their foot on the accelerator. In 2018, right as those massive losses were being disclosed, their capital spending surged by 91% year over year.
This sounds incredibly, almost eerily familiar.
It is the exact same pattern we are analyzing today. And the narrative in the financial press back then was absolutely brutal. Google Cloud was universally labeled a money pit.
I remember that.
It was widely seen as an expensive, stubborn vanity project driven by engineers who didn't understand finance. The Wall Street consensus was that Google was hopelessly throwing good money after bad, chasing Amazon and Microsoft, who simply had too large of a head start, and that Google Cloud would never, ever catch up or achieve profitability.
And how did the broader stock market react back in 2018 to this massive surge in infrastructure spending coupled with massive operating losses?
On April 24th, 2018, Alphabet held its earnings call and revealed a sudden, unexpected jump in quarterly CapEx to $7.3 billion. The very next day, the stock fell 4.8%.
Wait a minute. A sudden, massive jump in CapEx guidance, leading to an immediate stock drop of around 5%. That is literally the exact same market behavior, the exact same psychological reaction that we just saw this quarter in 2026.
The market hated the aggressive infrastructure spending then, exactly as viscerally as it hates the aggressive infrastructure spending now. Financial markets are notoriously impatient when it comes to multi-year capital cycles.
But here is the ultimate punchline to the historical parallel. What actually happened next? After 5 painful years of being universally derided as a money pit, what did that cloud segment actually achieve?
It achieved scale, and when it achieved scale, the unit economics turned. And when they turned violently into an unstoppable profit engine. Let's look at the financial results from 2023 through June 2026. In that 3.5-year span, that former money pit earned $37 billion in cumulative operating profit.
Let me just pause and make sure I am doing that math correctly in my head.
Yeah.
The division lost $18.8 billion over 5 grueling years of building the infrastructure. And then once it crossed the threshold of scale, it generated $37 billion in profit in the next 3.5 years.
Yes.
It paid back its entire disclosed history of losses almost twice over, in significantly less time than it took to lose the money in the first place.
Exactly. And the margin trajectory tells the story of how data center scale actually works. In its very first profitable quarter back in 2023, the cloud operating margin was a meager 2.6%. They barely squeaked into the black. Today, as we discussed earlier, that margin is 35.6%.
That is an astonishing financial turnaround. It completely validates the strategy of absorbing short-term pain for long-term structural dominance.
What is most vital to understand about this historical parallel is how the argument was ultimately settled. The critics and the bears in 2018 weren't silenced by Alphabet's management giving slick presentations with better forward-looking forecasts.
Right. Talk is cheap.
Exactly. They weren't silenced by promises of future growth. The argument was only settled by the actual hard, audited profits arriving relentlessly on the balance sheet year after year.
The profits were the irrefutable proof. And the core argument of our essay author is that we are simply watching the sequel to this exact same movie. Yes, the scale is vastly larger. We are talking about a $205 billion CapEx plan instead of a $7 billion quarterly surprise. But the underlying economic mechanics of building massive physical capacity ahead of a massive wave of contracted enterprise demand are identical.
Which naturally leads us to ask the final, overarching strategic question. Why is Alphabet so uniquely positioned to execute this specific strategy? Even if we accept that the strategy of building ahead of demand is sound, why are they the ones who can pull off a $200 billion infrastructure build without structurally breaking the company? Why not just outsource it or rent capacity like everyone else?
That brings us to the concept of the moat. We spend a lot of time analyzing competitive advantages, but what Alphabet has methodically built over the last decade is staggering in its integration. It all comes down to owning the entire technology stack.
This is a crucial defining distinction in the current AI race. Most of the players competing in this space right now, from well-funded startups to major enterprise software companies, have to rent at least one and usually multiple critical layers of their technology stack from third parties.
Give me a concrete example of what that looks like for a competitor.
Let's look at a hypothetical AI startup. They have a brilliant software idea, but they don't own data centers.
Yeah.
So they have to rent their raw compute power from a cloud provider like Amazon AWS or Microsoft Azure, paying a markup.
Right.
Furthermore, almost everyone in the industry currently has to buy their physical AI accelerator chips from NVIDIA, paying NVIDIA's famously massive 75% gross profit margins. And many companies, because they can't afford to train their own foundational models from scratch, have to license the core AI models from research labs like OpenAI or Anthropic, paying an API fee for every single query.
So they're essentially paying a heavy toll at every single gate along the path to delivering a product. They are squeezed on margins before they even reach the customer.
Yep. Exactly. But Google's architecture is fundamentally different. Google owns everything. They do not rent. They own the entire vertical stack. They design their own custom silicon, the TPUs we discussed earlier, bypassing NVIDIA. They secure their own land and build their own custom data centers to house those specific chips. They train their own proprietary foundational models like Gemini entirely on their own proprietary hardware.
And maybe most importantly, they own the ultimate consumer distribution channels. They don't have to spend billions on marketing hoping people find their new AI tools. They can deploy a new AI capability instantly, overnight, in front of billions of captive users through Google Search, Android phones, the Chrome browser, YouTube, and the Google Workspace suite.
The financial implication of owning this entire vertically integrated stack is profound. Every single dollar of profit margin that would normally leak out of the ecosystem to a supplier like paying the massive NVIDIA tax, stays completely inside Alphabet's corporate treasury. They're entirely insulated from supplier pricing power or hardware bottlenecks. In fact, the dynamic has shifted so dramatically that Google has recently begun selling their proprietary TPU chips as physical hardware to outside enterprise customers to install in their own on-premise data centers.
That is a wild strategic pivot. They went from designing chips internally just to avoid the NVIDIA tax to becoming a direct hardware supplier themselves. And this vertically integrated model leads directly to what the essay author coins four-way monetization. This is where the sheer, brutal efficiency of their capital spending really shines, and it explains why they can stomach a $200 billion CapEx bill.
Let's trace the life cycle of a single Google TPU chip to understand this efficiency. If a competitor buys an extremely expensive NVIDIA chip, they might use it solely to train a new AI model. That chip has one job, one path to generating a return on investment.
But a single Google TPU is an infrastructural chameleon. It can perform four distinct, highly profitable jobs simultaneously or sequentially across its useful lifespan. First, Google can use that newly installed TPU internally to train the next generation of their foundational Gemini model.
Second, once that model is fully trained, that exact same TPU can immediately pivot to running inference, meaning it actively processes and answers live user queries for Google Search and YouTube, directly powering and protecting their core advertising monopoly.
Third, if they have excess capacity, they can rent that exact same physical TPU out to external cloud customers via Google Cloud Platform, generating high-margin recurring enterprise software revenue.
And fourth, as we just mentioned, they can completely bypass the cloud and sell the physical TPU system directly as hardware to a client who wants to own it outright.
There is absolutely no competitor whose CapEx works that many different jobs at once. The financial return on every single dollar of infrastructure they build is multiplied because it serves four entirely different master revenue streams. And they are executing all of this from a position of almost unfathomable financial strength. Yes, they posted negative free cash flow this past quarter, but their core search revenue is still growing at 17%, and the cloud division is already generating nearly $9 billion in quarterly operating profit.
And if you're looking for external validation of this incredibly aggressive infrastructure-heavy strategy, you don't have to look much further than the ultimate arbiter of value investing.
We're talking about Warren Buffett.
Yes. The essay concludes by pointing out a very telling market signal. Warren Buffett's Berkshire Hathaway had been quietly accumulating shares of Alphabet since late 2025. But in June 2026, right as this entire debate over the massive CapEx plan was reaching a fever pitch and the broader market was panicking, Berkshire made a massive, highly public move. They bought $10 billion of Alphabet stock directly from the company in a targeted capital raise.
And what was the explicitly stated purpose of that specific $10 billion capital raise?
The funds were earmarked specifically to scale Alphabet's AI infrastructure. Buffett, the man famous for avoiding speculative tech bets, actively chose to aggressively fund the exact same physical infrastructure spending that the rest of Wall Street was panicking over.
The essay includes a fascinating quote from Buffett from around that time. When a reporter asked him why he wasn't deterred by the massive capital spending that had soured so many other institutional shareholders, Buffett simply pointed to the history. He said that Google is more likely to be a winner based on their record than probably 90% or 95% of what gets merchandised through Wall Street.
When Warren Buffett tells you to trust a management team's historical record of allocating capital over the short-term panic of Wall Street analysts, it carries a profound amount of intellectual weight.
So, after exploring all of this, the accounting mechanics, the backlog, the bears, and the historical parallels, how do we synthesize this? Let's bring this deep dive in for a landing and summarize exactly what we've unpacked today.
It truly is a tale of two wildly divergent perspectives. On one side, you have the consensus view of the broader market. The market looks at a rapidly escalating $205 billion capital expenditure plan and instinctively interprets it as a reckless, speculative bet on an unproven AI future. They see free cash flow go negative for the first time since 2004, they hit the panic button, and they dump the stock, erasing billions in value despite the company posting the largest quarterly profit in corporate history.
But on the other side, you have the perspective of our essay author, deeply supported by the historical and audited data. They look at that exact same $200 billion spending plan, and they see physical capacity being frantically built to fulfill a legally binding $500 billion contracted backlog. They see this infrastructure being deployed into a cloud segment that is already wildly profitable, with margins actively expanding as utilization scales. They see a company with a clean, audited, 10-year track record of accurately depreciating custom hardware, running the exact same infrastructure playbook they successfully executed back in 2018 to silence their critics.
As analysts, we have to hold both of these realities in tension. The bull case is undeniably compelling, driven by hard, signed enterprise contracts and incredibly deep, vertically integrated competitive moats.
Yeah.
But the bear case absolutely cannot be ignored or dismissed lightly. Michael Burry's theory on depreciation highlights severe structural risks for the entire AI industry. If hardware lifespans are indeed being systematically overstated across the sector, a reckoning is inevitable.
Yeah.
And that negative $5.9 billion print in free cash flow empirically proves the sheer crushing financial gravity of this undertaking. Alphabet is currently carrying the infrastructural weight of the entire digital future on its balance sheet.
It's a high-wire act with hundreds of billions of dollars and the future of computing on the line. And before we go, I know you have one final thought, something that builds on everything we've discussed today but takes the analysis in a slightly different direction for you guys to ponder.
I do. We have spent this entire deep dive talking about the accounting reality. We've meticulously debated depreciation schedules, operating margins, audit trails, and free cash flow metrics. We've established that if Alphabet's accounting is entirely honest and the enterprise backlog is truly solid, the demand is absolutely there to justify the $200 billion in spending. But this raises a profound, almost existential question that isn't found on any balance sheet. What happens if the physical world simply cannot keep up with the financial spreadsheet?
I'm not sure I follow. What do you mean by the physical world not keeping up?
I mean the brutal, uncompromising physical reality of building $200 billion worth of heavy industrial data centers. To deploy that much capital effectively, you don't just need money. You need vast tracts of properly zoned land. You need millions upon millions of gallons of fresh water to cool the servers. You need massive amounts of steel and concrete. And most importantly, you need gigawatts of baseline electricity. What happens if the physical world, the sheer availability of municipal electricity grids, the slow pace of local permitting, the limits of water rights, hits a hard, immovable limit before that $200 billion can even be fully deployed?
Right.
Does the physical reality of our planet's aging infrastructure eventually cap the accounting reality of Alphabet's hypergrowth? It is a constraint that isn't calculated in GAAP accounting, but it might be the ultimate unbreakable ceiling on this entire AI endeavor.
That is a fascinating and, frankly, slightly terrifying angle to consider. A $500 billion backlog of enterprise demand doesn't mean anything if the local utility company literally cannot generate enough power to turn the servers on. It shifts the bottleneck from finance to basic civil engineering.
Precisely. The financial math might work flawlessly, but physics and thermodynamics always have the final say.
What a brilliant and sobering place to leave it. As a reminder to everyone listening, this deep dive was adapted from a much longer, highly detailed written essay. Be sure to check the description for a direct link to the full article and visit the Behind the Moat website for more extensive coverage of these topics and other deep analytical pieces. Thank you so much for joining us on this exploration, and we will see you next time.